Bank regulation. A safe and stable national financial system is a critical concern of the Federal Reserve. The goal is not only to protect individuals' savings, but to protect the integrity of the financial system itself. This esoteric task is usually behind the scenes, but came into view during the 2008-2009 financial crisis, when for a brief period of time, critical parts of the financial system failed and firms became unable to obtain financing for ordinary parts of their business. Imagine if suddenly you were unable to access the money in your bank accounts because your checks were not accepted for payment and your debit cards were declined. This gives an idea of what a failure of the payments financial system is like. Bank regulation is intended to maintain the solvency of banks by avoiding excessive risk. Regulation falls into a number of categories, including reserve requirements, capital requirements, and restrictions on the types of investments banks may make. We learned that banks are required to hold a minimum percentage of their deposits on hand as reserves. On hand is a bit of a misnomer because, while a portion of bank reserves are held as cash in the bank, the majority are held in the bank's account at the Federal Reserve, and their purpose is to cover desired withdrawals by depositors. Another part of bank regulation is restrictions on the types of investments banks are allowed to make. Banks are allowed to make loans to businesses, individuals, and other banks. They are allowed to purchase U.S. Treasury securities, but, to protect depositors, they are not permitted to invest in the stock market or other assets that are perceived as too risky. Bank capital is the difference between a bank's assets and its liabilities. In other words, it is a bank's net worth. A bank must have positive net worth, otherwise it is insolvent or bankrupt, meaning it would not have enough assets to pay back its liabilities. Regulation requires that banks maintain a minimum net worth, usually expressed as a percent of their assets, to protect their depositors and other creditors. Bank supervision. Several government agencies monitor the balance sheets of banks to make sure they have positive net worth and are not taking too high a level of risk. Within the U.S. Department of the Treasury, the Office of the Comptroller of the Currency has a national staff of bank examiners who conduct on-site reviews of the 1,500 or so of the largest national banks. The bank examiners also review any foreign banks that have branches in the United States. The Office of the Comptroller of the Currency also monitors and regulates about 800 savings and loan institutions. The National Credit Union Administration, NCUA, supervises credit unions, which are nonprofit banks owned and run by their members. There are over 6,000 credit unions in the U.S. economy, though the typical credit union is small compared to most banks. The Federal Reserve also has some responsibility for supervising financial institutions. For example, conglomerate firms that own banks and other businesses are called bank holding companies, while other regulators like the Office of the Comptroller of the Currency supervises the banks. The Federal Reserve supervises the holding companies. When the supervision of banks and bank-like institutions such as savings and loans and credit unions works well, most banks will remain financially healthy most of the time. If the bank supervisors find that a bank has low or negative net worth, or is making too high a proportion of risky loans, they can require that the bank change its behavior or, in extreme cases, even force the bank to be closed or sold to a financially healthy bank. Bank supervision can run into both practical and political questions. The practical question is that measuring the value of a bank's assets is not always straightforward. As discussed in a bank's assets, or its loans, and the value of these assets depends on estimates about the risk that these loans will not be repaid. These issues can become even more complex when a bank makes loans to banks or firms in other countries, or arranges financial deals that are much more complex than a basic loan. The political question arises because the decision by a bank supervisor to require a bank to close or to change its financial investments is often controversial, and the bank supervisor often comes under political pressure from the owners of the bank and the local politicians to keep quiet and back off. For example, many observers have pointed out that Japan's banks were in deep financial trouble through most of the 1990s. However, nothing substantial had been done about it by the early 2000s. A similar unwillingness to confront problems with struggling banks is visible across the rest of the world. In East Asia, Latin America, Eastern Europe, Russia, and elsewhere. In the United States, laws were passed in the 1990s requiring that bank supervisors make their findings open and public, and that they act as soon as a problem is identified. However, as many U.S. banks were staggered by the recession of 2008-2009, critics of the bank regulators asked pointed questions about why the regulators had not foreseen the financial shakiness of the banks earlier, before such large losses had a chance to accumulate. Bank runs. Back in the 19th century and during the first few decades of the 20th century, around and during the Great Depression, putting your money in a bank could be nerve-wracking. Imagine that the net worth of your bank became negative, so that the bank's assets were not enough to cover its liabilities. In this situation, whoever withdrew their deposits first received all of their money, and those who did not rush to the bank quickly enough lost their money. Depositors racing to the bank to withdraw their deposits, as shown in Figure 1, is called a bank run. In the movie It's a Wonderful Life, the bank manager, played by Jimmy Stewart, faces a mob of worried bank depositors who want to withdraw their money, but manages to allay their fears by allowing some of them to withdraw a portion of their deposits using the money from his own pocket that was supposed to pay for his honeymoon. The risk of bank runs created instability in the banking system. Even a rumor that a bank might experience negative net worth could trigger a bank run, and in a bank run, even healthy banks could be destroyed. Because a bank loans out most of the money it receives, and because it keeps only limited reserves on hand, a bank run of any size would quickly drain any of the bank's available cash. When the bank had no cash remaining, it only intensified the fears of remaining depositors that they could lose their money. Moreover, a bank run at one bank often triggered a chain reaction of runs on other banks. In the late 19th and early 20th century, bank runs were typically not the original cause of a recession, but they could make a recession much worse. Deposit insurance. To protect against bank runs, Congress has put two strategies into place: deposit insurance and the lender of last resort. Deposit insurance is an insurance system that makes sure depositors in a bank do not lose their money, even if the bank goes bankrupt. About 70 countries around the world, including all of the major economies, have deposit insurance programs. In the United States, the Federal Deposit Insurance Corporation, FDIC, is responsible for deposit insurance. Banks pay an insurance premium to the FDIC. The insurance premium is based on the bank's level of deposits, and then adjusted according to the riskiness of a bank's financial situation. In 2009, for example, a fairly safe bank with a high net worth might have paid 10 to 20 cents in insurance premiums for every $100 in bank deposits, while a risky bank with very low net worth might have paid 50 to 60 cents for every $100 in bank deposits. Bank examiners from the FDIC evaluate the balance sheets of banks, looking at the value of assets and liabilities, to determine the level of riskiness. The FDIC provides deposit insurance for about 6,509 banks. As of the end of 2014, even if a bank fails, the government guarantees that depositors will receive up to $250,000 of their money in each account, which is enough for almost all individuals, although not sufficient for many businesses. Since the United States enacted deposit insurance in the 1930s, no one has lost any of their insured deposits. Bank runs no longer happen at insured banks. Lender of last resort. The problem with bank runs is not that insolvent banks will fail. They are, after all, bankrupt and need to be shut down. The problem is that bank runs can cause solvent banks to fail and spread to the rest of the financial system. To prevent this, the Fed stands ready to lend to banks and other financial institutions when they cannot obtain funds from anywhere else. This is known as the lender of last resort role. For banks, the central bank acting as a lender of last resort helps to reinforce the effect of deposit insurance and to reassure bank customers that they will not lose their money. The lender of last resort task can come up in other financial crises as well. During the panic of the stock market crash in 1987, when the value of U.S. stocks fell by 25% in a single day, the Federal Reserve made a number of short-term emergency loans so that the financial system could keep functioning. During the recession of 2008-2009, the quantitative easing policies discussed below of the Federal Reserve can be interpreted as a willingness to make short-term credit available as needed in a time when the banking and financial system was under stress. Key concepts and summary. A bank run occurs when there are rumors, possibly true, possibly false, that a bank is at financial risk of having negative net worth. As a result, depositors rush to the bank to withdraw their money and put it someplace safer. Even false rumors, if they cause a bank run, can force a healthy bank to lose its deposits and be forced to close. Deposit insurance guarantees bank depositors that, even if the bank has negative net worth, their deposits will be protected. In the United States, the Federal Deposit Insurance Corporation, FDIC, collects deposit insurance premiums from banks and guarantees bank deposits up to $250,000. Bank supervision involves inspecting the balance sheets of banks to make sure that they have positive net worth and that their assets are not too risky. In the United States, the Office of the Comptroller of the Currency, OCC, is responsible for supervising banks and inspecting savings and loans, and the National Credit Union Administration, NCUA, is responsible for inspecting credit unions. The FDIC and the Federal Reserve also play a role in bank supervision. When a central bank acts as a lender of last resort, it makes short-term loans available in situations of severe financial panic or stress. The failure of a single bank can be treated like any other business failure. Yet if many banks fail, it can reduce aggregate demand in a way that can bring on or deepen a recession. The combination of deposit insurance, bank supervision, and lender of last resort policies help to prevent weaknesses in the banking system from causing recessions. Thank you for watching BookTube channel. Make sure to smash the like and subscribe buttons to receive notifications about new contents.